please read and pay attention to the disclaimer on this slide. Before we jump into the topic of stock valuation, let's talk about business valuation in general. Remember, when you buy a stock, you're becoming an owner. Don't forget that. Think like an owner. Here's an example to help. Let's imagine that you win $15 million in the lottery. You decide to quit your job and retire to Florida to live near the water. You know that it's important to make your money work hard for you. So, you decide that you're going to buy a health club in South Beach, Miami, and live off the income it generates. You call a business broker and ask about health clubs for sale in the area. It turns out that there are 2 for sale. Both health clubs are located on the boardwalk in front of the beach, and both have almost identical designs and layouts. Each club generates $5 million in revenue and $1 million in profit per year. The owner of Club 1 is asking for $5 million. The owner of Club 2 wants $15 million. Thanks to the lottery, the asking price itself is not an issue. So, which club would you prefer to buy? If you buy Health Club number 1, then you're paying 5 times 1 year's profit, because the asking price of $5 million divided by $1 million in profit equals 5. That's a 20% yield on your money. If you buy Health Club number 2, then in that case, you're paying 15 times 1 year's profit, because the asking price of $15 million divided by $1 million in profit equals 15. That's a 6.7% yield on your money. With the information provided, Health Club number 1 appears to be a much better deal because it would pay you triple the return on your investment. If you think about valuation when buying a gym, you'd better think about it when buying a stock, as we'll soon see. If you ever want to invest in individual stocks and not limit yourself to just funds, understanding and paying attention to valuation is an essential skill. How do experienced investors use valuation metrics, like the price-earnings ratio? First, the PE ratio makes apples-to-apples comparisons across different companies quick and easy. That makes comparing multiple companies' valuations much easier. Second, beyond that benefit, the PE ratio can be used to evaluate the absolute value of a company. That means looking at a company without worrying about where other companies are being valued. Think of it this way. The PE ratio measures what investors are paying to own just $1 of a company's earnings. We're going to explain all of this further. First, let's talk about the P in the price-earnings ratio. The P stands for a company's share price. It's the most recent price where a company's stock traded at. The E stands for earnings per share, EPS, which is the net income of a company divided by the shares outstanding, otherwise known as the total number of shares in existence. By converting net income to earnings per share, we can look at the ratio of the price of one share to that single share's earnings. Companies typically provide earning per share data. Still, it's worth understanding how it's calculated. Recall from Lesson 4 on accounting, the green circle is where we find Microsoft's net income on its income statement. In the case of Microsoft, net income for their fiscal 2023 was $72.4 billion. For the shares outstanding number we need for the earnings per share calculation, companies provide that number in their financial reports, typically at the bottom of their income statements. Remember, the shares outstanding are the total shares in existence. The number of shares we're looking for is called the fully diluted shares outstanding. I know it sounds complicated, but the term just means the number of shares in existence, factoring in potential new shares from sources like employee compensation plans. In the case of Microsoft, the fully diluted shares outstanding as of the date of their 2023 annual report was 7.472 billion shares. That number is highlighted in the green circle. Now that we have the net income and shares outstanding data for Microsoft, calculating earnings per share is simply dividing one by the other. $72.4 billion in net income divided by 7.472 billion fully diluted shares outstanding equals $9.68 in earnings per share. Once you have the earnings per share, The PE ratio is just the share price of Microsoft at that time, divided by the earnings per share. Based on the numbers on the slide, Microsoft is trading at 39 times its earnings. That means that at current prices, investors are paying $39 for every dollar of annual earnings the company generated over the past year. Remember earlier in the lesson we discussed picking a gym to buy in Miami? There's no difference between buying a gym or shares of Microsoft. In both cases, you get a share of the earnings they produce. In many ways, buying a stock is the same as buying a business.